3.9%. That is the entry yield Capital and Integrated Commercial Trust is accepting for Paragon, and if you think that sounds low, wait until you see what it does to the balance sheet. Today we are stripping back the prestige of Orchard Road to see the real cost of this move. I had to run the data on this deal twice, because I simply did not believe the gearing figure at first glance. That is one of those moments where the management headline says growth, but the forensic math says something else entirely. Turning to the SGX Daily Pulse for the 21st of April, 2026. We have a heavy session of forensic work ahead. We are doing a deep dive into the Capital and Integrated Commercial Trust deal, issuing a major gearing alert for Aspial Lifestyle, and checking the strategic neutral stance on Fraser Centerpoint Trust. As I always say, it is a good Tuesday for forensic work, because when the market gets busy, that is exactly when the most important details start to get dressed up or hidden in the footnotes. Starting with the macro picture for Capital and Integrated Commercial Trust. We have a dual red flag situation. This is not a minor miss. It is a yield trap and a gearing breach hitting at the same time. The yield on the Paragon acquisition is coming in at 3.9%. That is 80 basis points below my 4.7% mandatory hurdle. And worse, the pro forma gearing is climbing to 39.2%. That is a standalone forensic disqualifier. My ceiling for Sanctuary Holdings is 35%, and they have crossed it. Here is how the deal actually looks. The REIT is divesting Asia Square Tower 2 at a 2.5 billion Singapore dollar valuation, with a 3.0% exit yield to fund the acquisition of Paragon for 3.9 billion Singapore dollars. Management is touting a 2.1% DPU accretion, but you have to read the fine print. That number assumes both the divestment completes and they receive a stamp duty exemption. Strip that exemption away and your accretion falls to a very thin 1.6%. When we look at the peer benchmarks, that Orchard premium becomes very hard to justify. Starhill Global REIT holds a portion of NG and City right next door. They are carrying a derived net property yield of approximately 5.36% on a 2.8 billion Singapore dollar portfolio. For Capital and Integrated Commercial Trust to enter Paragon at only 3.9% means they are paying for prestige that their own yield cannot justify. In this market, prestige does not pay the utilities. Now let's run a stress test on these numbers. If luxury retail spend drops by just 10%, perhaps triggered by a strengthening US dollar, that 2.1% accretion is wiped out entirely. For a 55-year-old PMET in Ang Mo Kio who treats this REIT as a safe sanctuary holding, the real-world consequence is a potential 5% erosion in net asset value if cap rates expand. This deal fails 2 forensic tests independently. For me, that makes it a clear yield trap. Moving to the Aspial Lifestyle gearing alert, we are looking at 70.8% gearing and an interest coverage ratio of only 1.3 times. When your ICR is that low against my 4 times floor, this stops being a yield play. It becomes a pure leverage bet with a coupon attached. The company is running a gold-backed lending operation, but it is being funded by high-cost capital, and the debt wall is the primary story here. And here is what the filing actually says. 28 million Singapore dollars in notes priced at 5.1% per annum, due in October 2029. That 5.1% coupon clears my 4.7% hurdle on paper. But the balance sheet context makes that number almost irrelevant. The cost of funding is high, the interest coverage is thin. When you are geared this heavily, you are running on borrowed air, regardless of what the earnings recovery looks like. Look at the sector peers to see why this is a forensic outlier. Hourglass operates in the same luxury and lifestyle space, but they do it with zero net debt. Aspial's 70.8% gearing is not a temporary phase. It is a structural risk. A 10% drop in gold prices would squeeze that 1.3 times ICR toward the 1.0 mark. That is covenant breach territory. For a 45-year-old HDB owner in Punggol, you are taking equity-level risk for a fixed return. Before we move on to Fraser Centerpoint Trust, if you want this level of forensic depth on every SGX filing as it happens, Iggy's elite investors get these breakdowns on day 0. Check the link in the description to see the full red zone watch list before the market reacts. Earnings at Aspial have improved, and that is real, but having improved earnings sitting beneath a 70% gearing ratio is forensic extreme spots. There is simply no margin here for a commodity shock or a rate surprise. Now for Fraser Centerpoint Trust, which I am categorizing as strategic neutral. They are in preliminary talks to divest White Sands for over 470 million Singapore dollars at an approximate 4.5% exit yield. This is just below my hurdle, which tells me this is a defensive move to reduce gearing pressure, not a way to extract the premium. And it is important to note there is no certainty of completion yet. No official pro forma figures have been published. The big question here is redeployment. If the proceeds from White Sands are redeployed into something yielding less than 5%, the divestment actually becomes DPU dilutive despite improving the balance sheet. For an investor in Tampines, this move represents a safer balance sheet but likely a thinner dividend check. The suburban portfolio is resilient, but the arithmetic on how that cash gets reused is not yet visible. We are staying neutral until we see the redeployment yield disclosure. Looking at the broader analyst chatter, Keppel REIT is a concern. Their organic distributable income is actually down 1.1% year-on-year. The headline is being propped up by a $5 million quarterly anniversary distribution. Do not mistake engineered yield for an operational recovery. Meanwhile, Citrium has refinanced 400 million Singapore dollars at 2.95%. That is a solid sanctuary move for their debt profile, even if the business itself remains operationally volatile. I want to remind everyone about the stress test buffer I use for these audits. I hold my forensic floor firm at 3.2%. Even if T-bills take a temporary dip, I do not lower my standards to match the market. That means a minimum yield hurdle of 4.7%, which is the floor plus a mandatory 150 basis point risk premium. And the 35% gearing ceiling remains a hard limit for any stock to be classified as a sanctuary. In this market, the window closes fast. The difference between a sanctuary and a yield trap is often decided in a single trading session. By the time this analysis reaches a free subscriber, the entry window I identified has usually already opened and closed. You have to be looking at the numbers when they still matter, which is why zero-day forensic breakdowns are so critical for retail investors who want to avoid becoming the exit liquidity for institutional players. The red flags were always there. Today's audit shows that even big names like Capital and Integrated Commercial Trust can trip over their own prestige. Whether it is a yield trap in Orchard or a leverage bet in luxury retail, the forensic math always tells the truth. Do not let a shiny headline distract you from a broken balance sheet. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access, link in the description. If you want to stop being the exit liquidity, you have to start thinking like an analyst. Iggy's elite investors get the full red zone watchlist and institutional-grade cheat sheets for less than the price of a kopi and kaya toast set at Raffles Place. For $9 a month, you get the numbers when they can still save your portfolio. It is time to stop following the headlines and start following the forensic math. Link is in the description to join the team. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.